The automakers have been facing a slowdown for months. The demand in the FMCG space has also been weak. Yatin Mota spoke to Jaideep Goswami of ICICI Securities to understand if a revival is around the corner and what measures can be taken to spark a revival. Listen in.
The growth numbers are kind of quite weak till the numbers that have been disclosed end of July. And the similar trend is still continuing in terms of weak demand environment and the pressure that the value chain is facing, both the distributors and ancillaries with regard to access to credit. One of the positive factors for the industry as a whole is obviously significant improvement in monsoon spread so far, which was an additional area of concern earlier, but recently the monsoon has played out very well. So there is a hope among auto manufacturers that there should be a revival coming around the festival season that is coming up. And because the degrowth started towards second half of last year, technically speaking, the numbers may still look good for the second half of the current year on year-over-year comparison. However, the benchmark that industry is considering as a kind of metric by which they will judge whether a revival is coming is the FY18 numbers. So that is some time away, and we may see a situation of weak environment prevailing, and there is a role to be played by various entities, by the banks and the ecosystem to do a broad-based confidence building measure which the society as a whole have to do in order to kind of give a boost in the sentiment of vehicle demand.
Jaideep, specifically talking about the confidence boosting measures, be it the auto sector or be it the general economy in terms of the demand slowness that we have seen, do you think the government stimulus needs to start first, or do you think the rate transmission, given the fact that RBI has cut rates, however the transmission is not happening, that will play an important role? What, according to you, should happen first in order to aid the overall sentiments on the ground?
In historic terms, if we see that every time there was a government stimulus package, the auto industry has seen a V-shaped recovery. That is the experience of 2001, then 2009, and then 2014. So all the time that government has announced very focused targeted stimulus measures, it has had a positive impact in terms of recovery of demand. So similar steps may be expected. There is deliberations going on between automobile industry and the government agencies as to what are the best steps that can be taken in terms of GST rate adjustment or other cost measures that can be postponed, if not postponed altogether for a limited period of time, a kind of a cost reduction initiative on vehicle cost of purchase, if it can be initiated. Obviously the industry is going through unique kind of Uber and mobility related a different operating environment in which we are seeing that the fundamental excess demand that comes from this segment has kind of weakened. As a result, there is need for a stimulus measure for sure. Howsoever, there is no problem in banking sector taking the steps to pass on the transmission of lower interest rate that RBI has been signaling. So both are needed, but probably stimulus is very much needed at this point in time.
Okay. Jaideep, we just concluded the first quarter earnings season. A lot of caution in management commentaries across sectors. As a house, what is the view in terms of FY20 earnings outlook? And more importantly, if you could share what were the broad standouts for the first quarter earnings and what kind of a trend do you see building up for FY20?
I think the underlying sentiment is one of risk aversion at all cost. So there is more and more concentration of portfolio position by domestic and foreign investors. Clearly the sectors which have been able to kind of withstand a kind of weak demand environment are technology sector, and post good monsoon the consumer sector, FMCG, select companies in these two space could be the sectors where we can see a kind of somewhat of a resilience in the earnings outlook going forward. So we have to choose the market leader in this space. The sector which can give opportunity for selective investment opportunity is in the private banks space, clearly the sector where the stress has been less, and they have been a net beneficiary of the crisis that has unfolded in NBFC space in their portfolio build out side, and they will also gain in market share. So these are the 2-3 very select segment of the market where we think the foreign and domestic investors are interested, and we have seen deal flows in these areas also getting lapped up by investors. So it's basically going to be more and more selective and stock picking kind of environment where one needs to be very careful and kind of tide over this crisis that we are in right now.
Okay, and Jaideep, quickly, since you track the BFSI space very well, there is a lot of cry and a lot of hue as far as the entire NBFC segment is concerned. A lot of companies are getting impacted because of the tight liquidity. On the other hand, we have the IBC process which has got slowed down because of various procedural reasons, and on the other hand we have the private sector bunch which is doing well in terms of the share price performance as well as the investor interest. So in the entire BFSI space, how do you see earnings move in the second half of this financial year? You said that there is opportunity for the private sector banks where stress is reducing, but what about the NBFC segment as well as the PSU banking lot?
In the NBFC segment, we are seeing clear divergence between the NBFCs which has got access to domestic and foreign external commercial borrowing related liquidity. Those are the companies which are differentiating itself vis-a-vis a large number of other NBFCs which are clearly facing a growth related problem due to their lack of access to liquidity on the liability side. So there will be a separation of earnings growth performance in the second half, and the NBFCs which are stronger and which are having higher rating and access to domestic and FII liquidity will be the companies which are likely to show growth, such as companies in Shriram Group